Hi, so we'll be talking about Singtel, Singapore Coal Monthly, US Weekly, China Weekly, and the Phillip Singapore Weekly today. So for the Airtel fundraising, they'll be raising 3.5 billion from rights issue and the rest from perps. The promoter group, which consists of Bharti Telecom and Bharti Group, along with Singtel, will subscribe for 67% of the rights issue. Singtel is to subscribe US 525 million in rights issue. Total investment for from Singtel to Airtel is US 900 million in these 12 months. So for the impact, Singtel will be diluted to 35.2% from 39.5%. Still largest shareholder in Airtel. So they will fund this through cash and debt. Net debt to EBITDA is still healthy at 1.68 times. So the situation in India is stabilizing. It has consolidated from 10 to 4 operators. ARPU is improved, supported by introduction of minimum recharge plans. So these minimum recharge plans are for prepaid plans, required to top up RS23 for 28 days. If not, the telco will cut off the line. So this has supported ARPU. You can see the Q-on-Q ARPU increase in Q3 FY19. We also expect competition from Reliance Jio to rationalize. As you can see in figure 3, as of December 18, Reliance Jio and Airtel shares the same market revenue share. The key thing to note here is that Airtel has been able to maintain their market share of 30%, and the rest of the peers have been losing market share to Airtel, to Reliance Jio. So for the debt levels are healthy. Moody's will downgrade rating either of these two conditions. Net debt EBITDA less than 2%, less than 2. Adjusted associate cash dividends back to core EBITDA. So you can see in figure 4 FY18 it's 1.52 and FY19E is 1.68. This is adjusted after adjusting the cash dividends back to the core EBITDA and after the Airtel rights issue. For the second condition, EBITDA margin below 30% on a sustained basis. For FY19E, EBITDA margin 27.5 is pretty weak. However, we feel that it's not reflective of its position because of the change in accounting standard. It has no impact on bottom line. So for figure 6, the peer net debt to EBITDA, Singtel is trading at 2.07 and the peers are at 1.95. Bharti is at 4.21. So this is rather in line with the industry. So we maintain our accumulate core with a target price of 3.27. We expect a moderate recovery in associates driven by Telkomsel and Airtel. This represents 40% of earnings for all of associates. We think that the enterprise segment is to offset weakness in the consumer business, and the ICT has a healthy order book of $2.9 billion. We continue to like Singtel because of its diversified earnings and stable dividend yield of 5.8%. Next, I'll pass it on to Guang Zhi, who will talk about the Singapore Coal Monthly.
Okay, thanks, Alvin. So this is Guang Zhi. Next, I'll talk about the Singapore Coal Monthly update. This is for the February date. So what happened in February was that China's imposed the restriction on Australian coal imports. So in February, the Dalian Customs imposed an indefinite restriction on Australian coal imports. There are 5 ports under the customs we have executed the ban, and meanwhile the overall market has been slowing down the customs clearance of Australian coal by at least 40 days. And following the catastrophic mining accident in January, the Ministry of Energy of Yulin City announced the approval for the resumption of mining work for 2 batches of mines. So the first batch of 49 mines with an annual capacity of 168 million tons, and the second batch of 50 mines with an annual capacity of 35.6 million tons had resumed the mining work by the end of February. And meanwhile, in Indonesia, the demand for the thermal coal is up due to the ban on Australian coal. And some smaller scale high CV producers are returning to the market because these producers, they were receiving more inquiries for high CV coals from China in February. So we think that the temporary supply short actually boosted the coal imports, but it is unsustainable. So in January, the total coal imported to China jumped by 19.5% year-on-year and 227.5% quarter-on-quarter, and especially for the Indonesian coal imports, which surged by 16% year-on-year to a 3-new year high in January. And because the port coal inventory was replenished substantially in January, so we see the total coal import data in February plunge as well. So because the winter season is going to end, so we think that the demand for coal is tapering at the moment. And another thing is we think that the Indonesian coal has the potential to partially fill the supply gap because this year the China's central government will continue to curtail the remaining 150 million tons of capacity to finish the total of 800 million tons of capacity, which stated in the 13th five-year plan. And we think that the demand for the seaborne coal will remain intact, so the Indonesian coal has the room to fill up the gap due to the ban on Australian coal. But of course, these coals are the high CV coal. So these 6 charts are our monthly checkers on the market. You can see here, this is a coal import from Indonesia to China. So actually it surged substantially in January, hit a new record high. And meanwhile, the domestic prices in Indonesia stabilized over the past few months at above $90 per ton. And because of the supply shortage in January due to the mining accident, so the coal prices actually were boosted for a month. And also this is the port coal inventory level. We can see that in February and January, it continued to go up because the Indonesian coal actually was immune to the restriction. So that means they replenish this inventory partially. So next I'll pass on to Edmund to talk about US market.
Thank you, Guangzi. So right now I'll cover the US weekly. So for the macro last week, the University of Michigan's consumer sentiments increased from 93.8 to 97.8, and it beat the consensus of 95.3. But that is still below the peak of 101 reached last March. As for industrial production, it edged up slightly by 0.1% in February. The gains were mainly concentrated in utility output and mining. But the rebound in utilities output is due to the unusually cold temperatures in the northeast, which boosted demand for heating. There was also a 0.3% rise in mining output as drilling activities posted a surprise increase. That may reflect that the continual recovery in crude oil prices is in recent weeks, but at their current level, they still suggest that mining investments will fall sharply over the first half of this year. The auto output also fell a slight 0.1% in March, although the consensus is that many expected an increased rebound of the auto output. The headline CPI inflation edged down to a 2.5-year low of 1.5% in February. Core inflation also dropped to a 4-month low of 2.1%. The value of overall sales rose 0.2% after a 1.6% decrease in the prior month. And sales in the control group, which is said to be a more accurate indicator of sales, rose 1.1%. So all in all, the weak figures and especially the inflation indicators suggest that it is very unlikely for the Fed to raise interest rates for the upcoming FOMC meeting. As for the corporate news, Adobe reported better than expected EPS and revenue. So Document Cloud segment achieved a record revenue of $282 million. There's also a continued momentum for Adobe Creative Cloud and Experience Cloud. It is likely that for the year ahead, the key driver for Adobe will be Adobe Creative Cloud. Oracle also reported better than expected EPS, although its revenue is flat. Cloud services and license support revenue increased by 1% year-on-year, while the cloud license and on-premise license revenue decreased by 4% year-on-year. But this is mainly due to the currency headwind. Growth in the higher margin autonomous database and the Gen 2 cloud is likely to offset the declines in its legacy products. So as mentioned, for the week ahead, the key indicator that we are all looking at will be the Fed interest rate decision on the 21st of March. As for these are the list of upcoming earnings release. So right now, I'll pass on my time to Jieyuan.
Thanks, Edmund. For China last week, we are seeing the disappointing macro numbers at the volatilities to stock market. Especially, we are looking at the survived jobless rate. February survived the jobless rate reached about 5.3%, and almost reaching the government target point, which is 5.5%. So we are expecting the more industrial policies and policy stimulate coming in this month and next month. For the stock recommendations, our Hong Kong research teams recommend BRD Automobile. Although the BRD Q4 results basically stay flat, but we are seeing the new energy vehicles business is getting better. Because of the China government is giving more subsidies for the new energy vehicles, the Hong Kong research teams to still give the accumulated recommendations and give the target price to 15.6.3 Hong Kong dollars. This is the list of our Hong Kong research teams stock recommendations. Next, I will pass to Ming to talk about the SGX.
So for SGX, there was a recent news last Monday of Hong Kong Exchange releasing the MSCI China A shares index futures as well. So currently, SGX is the only one in the offshore market offering the FTSE China A50 index futures. So with Hong Kong coming in with this new China A index futures, it will pose as a competition to SGX as well. So to provide more color on how this will impact SGX, so derivatives revenue has been contributing around 50% of SGX total revenue for the past 2 quarters. And China A50 is the largest contributor to the derivative revenue of around 40%. So the impact on Hong Kong's this move by Hong Kong will actually affect the amount of clients of the China A50 of SGX in the long term. So based on February's 19 statistics released by SGX, derivatives average value year on year actually only rose 1.4%, and this is the slowest in almost 2 years. So coupled with slowing derivatives growth and also the securities daily average value has not increased as well. So all these will actually pose as a vulnerability for SGX in the near term as well.